Hey folks, David Frost, My Strategic Forecast. You're here for another episode of Common Sense Market Analysis. Today is Friday, August 5, 2016. We're looking at a daily chart of the SPDR or SPY, which is the proxy for the S&P 500. And here you have it. So I took a couple of lines off the chart, and we're probably going to take another one or two off tonight. But the point is that the market's doing exactly what we've talked about over the last several days. In brief, and we're not going to belabor this one, but this is a bullish pattern, and we knew that as long as we closed above the 215.31 level right here and remained closing above that level, that was critical for the market, and that would keep the market in the most bullish position that it could be in, and hence we had the phony jobs number this morning. Honestly, I don't even know what they said. I haven't a clue. But what I do know is that the market reacted the way it did, and that's all we care about, where we got confirmation that once the market started higher and it looked to be that there was no negative reaction from that number, that was in and of itself confirmation for me that we're going to reach the number. And I had on here previously 219 down here, okay? I had on there 219. I've actually upped it to 219.47 because I spent some time trying to calculate the number. And it doesn't really matter whether it's 219, 219.50, or 220. And I'll get to the reason why it doesn't matter in a second. But what I did was I used some techniques that I typically will use when markets, or stocks for that matter, are at new all-time highs or new all-time lows. It's very difficult to project where a market or a stock may stop at new all-time lows or highs. So it is a very difficult endeavor to pinpoint the number. So I'm putting the number up there only for fun, just to see what happens. It's going to be somewhere in that neighborhood. I'm not expecting it to be 219.47, although I do expect it to be probably within 50 cents of that, if not less. So that's the number we were talking about, 219 to 220. And here's the thing. Okay, I said to you that this was all going to take place, and we talked about this last night, and I alluded to it the night before, or even a couple of times, that this is going to take place all into mid next week. Now, I'm going to actually move that slightly forward because of the move today, and I can project that the highest probability is that we're going to reach these numbers, if not Monday, by Tuesday at the outside. So the reason why that becomes important is because I think, and whether or not it's for a longer term or it's only for a few days, I think that level will be a stone cold short. Let me repeat that. I think if you can catch a short in between 219 and 220 on the SPDR, whatever vehicle you want to use, and it doesn't even matter whether you use the inverse of the IWM. We have a position in TSA that's obviously getting hit. I'm in that position. I have no intention of unloading that position because I know the market's going to come back down. And to me, based on my work, I believe this is the completion of this pattern that's going to take place over the next, let's say, 2 trading sessions, maybe 3 on the outside, but I don't even think that. So with that being said, what I'm looking for is, and I will tell you, I normally will mention that in order to find a top in the market, we really need a reversal day, a reversal signal, an engulfing candle, a doji, a high volume reversal day, a gap up, and a failure and finish near the lows, something to tell us that the market has changed its face. And in this particular case, I would love to see that, but I am not going to be afraid to add to short positions up in that area. And I will tell you, full disclosure, I will get aggressive up there. I'm not suggesting you do anything. I'm suggesting you do what you want. You're individual traders just like me, and everybody has their own risk tolerance and everybody knows what their limitations are, I will have my risk measured accordingly, meaning I will only let them go so far, but I'm not necessarily intent on waiting for the high volume reversal or the reversal signal. I'm going to start purchasing more positions on the short side or selling short the market on Monday or Tuesday up in that neighborhood. I am fairly confident of that. So I thought that was important information that you can know. Do with that what you want. It's up to the individual trader. And as far as that goes, there's really nothing else to discuss at this point in time as it relates to the spider. When we do make a turn and we have a pivot top in place, then I will be able to calculate what support levels will be most prevalent on the downside in the short run, and if it becomes a more prolonged sell-off in the longer run. But I need to have a pivot top in place in order to do that. So until we do, there's nothing else to discuss on the spider. To me, it looks like we're headed up in those or to those levels. So there's not really much else to talk about with the IWM. It's the same routine. I did not do the calculation on the IWM in terms of how far it will go. It doesn't really matter. You can use the spider as a proxy, as a gauge for when the market should be in an area where there should be very, very limited upside from that point. And that will be that, call it 219.5, give or take. That's the zone where all these markets will likely turn together, some before others. But that's why I didn't need to spend the time doing the calculation. The IWM was up 1.44% today, leading the market. The spider was up 0.8%. And by the way, and I always do this, the volume today was 71 million shares against an average of almost 97 million shares. Again, better volume than the last few days, but certainly not institutional participation that would signal to me that a new bullish trend is starting. That would look a lot different than we saw today. You would have at minimum of double that volume, if not more, if that were the case. So I thought that was also important to make mention of. So the IWM had average volume today, and that's pretty good for the IWM. It was a big stat up day. Money was flowing into risk assets, the IWM being one of them. The NASDAQ composite was up over 1%, outpacing slightly the spider. And the spider was up, 0.8. I mentioned that. We'll get to the transports in a second. And the Dow itself was up just about 1%. So there's your numbers for the market. Here's another one for you. Here's the VIX. So very important on the VIX. So here's the story is that even though I was an accumulator in this zone, okay, I am going to be another accumulator in the VIX, doing most likely call options or the inverse, not the inverse, but the leveraged products also. Down in this area, 10.5, 11, anywhere down in this zone. We know, and I've done this before, let's do it one more time. We know where we are, right? We're in the zone where how many times does the VIX come below these levels? And it's not very often, okay? So it's been since 2014 that we were below these levels for any kind of sustained period of time, and it wasn't even a sustained period of time. It was only for a day. So there's no reason to believe, in my book, that the VIX is going down and going to stay down at much lower levels. So this is another trade that you can take a look at early next week. It's a very high probability trade in my book. And for those of you that care, Monday will be the 7th day down in a row for the VIX since the peak. That's meaningful to me. All right, let's run over to the transports, and you'll see a robust day in the transports. Look what happened here. We had a nice recovery at the end of the week. Look for the transports to have another upside move. Let me go to the daily chart because we're not really going to focus on the weekly. We came into the 20-period moving average today. Maybe 79.50. is going to be resistance for the transports. I don't see it getting much higher than that on this run, with the next move expected into Monday and Tuesday in the markets. I'm sure the transports will get a lift along with the rest of the markets, another point or so up in the spider. So the transports should get pulled along, but I'm not looking for them to break out to new highs, and I'm certainly not looking for them to recapture the inverse head and shoulders pattern that we drew in here quite a while ago now. Let me draw it in for those of you that can't see clearly. It's been a little while. So here's your left shoulder, here's your head, and here's a right shoulder. And we were never able to bust through or breach the neckline of the inverse head and shoulders pattern, and I don't expect that into Monday and Tuesday of next week. And since I am expecting a turn at that point in time, my expectations is the transports will probably stall out. My guess is 79.80 is the number. 79.50, 79.80 in that zone is probably the best bet for anybody that wants to know where to short the transports if you're interested, or via one of the other vehicles, which is the I believe it's the IYT, which is the ETF for the transports, IYT. So here's your IYT on a weekly basis, and this still does look bullish, but we're coming up against double top, and it looks to me like a failure is in the offing. If I'm right in the whole scenario, and here's your IYT, and this would be a short against, in the IYT, if you were short against the IYT, you would be short against a close above, a daily close above 144.41. That would be the safe play. It's not too far away in percentage terms. It's a pretty good risk reward. So you get it a little higher on Monday and Tuesday, and you could short it against that level, or you can even go a little bit deeper and short it against 146.07 would be even a better bet. When you look at that on the weekly chart, that's up in this zone here. Where was that number? 146.07. So that would be a breakout, and I don't expect that to happen. So there's your shorting against level, but wait for it to get a little bit higher on Monday or Tuesday if you're interested in the IYT. Let's go to gold. Interesting day in gold, right? So what we had was, this is the weekly chart. Well, let's talk about it for a second. So a few weeks ago, we had a big down week. Okay, and a big down week is generally a sign of a trend change in the market when you have an engulfing candle on a weekly chart. And now what we've seen is we've seen gold try to rally back up to those highs and now failed this week, and now we're coming back down. Now it doesn't look like much on the weekly chart, doesn't look like anything to be concerned with on the weekly chart. In fact, we could certainly make a case that this is an up move and it's just a pullback and we're getting ready for another up move. But let me drill down a little deeper for you, and I did some work in gold and I want to show it to you. So here's what I think is the case in gold. This is my best scenario. In fact, let me do this and then you'll get the picture. Okay, so what I believe is a daily close below 1335 is going to produce a downward move that will first find some level of support down here at this double bottom area around 1318, 1317 area, okay? But that could be for hours or it could be for a day or two. That is possibility. The next level of support you're going to find is going to be at the 50-period moving average. Same scenario. Not exactly sure how much support that will lend. Could be hours, could be a couple of days. But what I do believe is the case that we are headed down. If we breach 1335 on a daily chart close and confirm, then I think we're headed down to, let's call it 1300. The mathematics come out to 1297. So anywhere within a few dollars of this zone here of 1297 is a reasonable target. And I think that's a pretty reasonable risk reward as well if we breach 1335. And if we do, and you find yourself short the gold market and we close the day back above 1335, I would look at that as a warning sign not to be short until a breach back and a close back below 1335. So hopefully that's helpful information. And you'll know that when we saw gold going up and it was coming back down, I felt that it wasn't necessarily going to break out just yet. We are going to see higher prices in 2016, but I thought that it really needed to have more of a pullback, and that's the position we took. I actually took a position, as you know, in ZSL, which is short the silver market, pardon me, and I thought it was the better setup after this high volume reversal, and we've been kind of stuck in this trade. I don't know how many out there are in that trade with me, but I'm stuck in this trade a little bit for a while, and now it's starting to work out again, obviously. Still out of the money by about $1.50 in ZSL, but that's okay. That's not the end of the world. So what I believe is going to take place is silver is also going to come down along with gold, and I think a good target for silver is the 382 retrace. Since I've already got the fib lines up here, I'm going to cite this as the target, and we talked about this level a number of times. That's a good level, and if that breaches, then this is going to be a wonderful level down here. I will be taking the ZSL trade off beginning in here and most likely finishing in here, and we'll talk more about that if and when silver and gold begin to come down to those levels. They do have some work to do on the downside to get that kind of a move underway, but I wanted to bring that to your attention as well. So there's a lot going on in the markets, and if you remember, you know, for the last few weeks it was been very quiet, and it was almost like eerily quiet, and now we're getting some movement. So the fact that we're getting movement creates opportunity, even if we have to wait. Those of you, and some of you may not be long the stock market, you may be waiting for a short. You may be already short with me in some respects. And now you can see where, at least from my perspective, it's becoming much more clear what's happening. Obviously, it's, you know, not being Captain Obvious today. It became clear this week. And then now I can see relatively clearly where the culmination point of this move should be. And that creates opportunity for us. And that's what we like to see. So let's go over to the crude oil market. And we'll look at, I got the wrong chart up here. Let me get the continuous contract. And you can see here that we didn't do much today in crude. It was down a little bit today. We came down to test some lower levels, scare some people out, thinking that the move was over on the upside, and it may be, but I don't believe it is. I think what's happening here is we're probably just putting in a nice pause after a move from 39 up to, bear with me here, let's get the top, up to 42.08 and 42.10. So today's high was 42.10, tried to breach the high, didn't make it. But we can be putting in a sideways consolidation pattern. We can start back up next week. Anything's possible. It's interesting, though, with, you know, gold selling off. I'm wondering what's going to happen with crude next week. They do tend to trade in tandem a lot of the time. Not recently, but a lot of the time. So it'll be interesting to find out what the story becomes in the media. I don't really care what the media says or not. But our line in the sand for long play, in my book, is 40.56. And any close below 40.56 and the long play is off the table. Any remaining closes above that, and I do think we make it to 42.50 and then potentially even higher, but let's take it one step at a time and let's see what happens. I wouldn't be surprised to see crude oil up with the market into Monday and or Tuesday, and then I believe that that would probably be a good exit for those of you that are long the crude oil trade from the bottom down here at 39 and change, wherever that was, or wherever some of you, I know some of you took that trade, so wherever you got in, obviously protect it right now. You should have a stop in the money. You should maybe have even taken some profit. That's always up to you, but you know my philosophies. And so that's the story in crude. Let's go over to the bond market, and we'll cover the 30-year Treasury. And you can see we had a nice sell-off in the Treasury market today, but Interestingly enough, we remain above our critical level of 171.7. And what was the low today was precisely 171.11. So we flirt with this level. The more we flirt with it, the more prone it's going to be to give way. But right now, it is where it is. I have a sneaking suspicion that, and let's tie this back to the stock market. I have a sneaking suspicion that we may trade down into the 50-period moving average on Monday or maybe even into Tuesday in the bond market. And then when the stock market finds a top and turns down, I think the rally ensues in the bond market. Or option B is that the bond market sniffs the whole thing out ahead of time and starts higher on Monday and becomes the canary in the coal mine. Either way, I think we'll have higher bond prices when the stock market finally rolls over or puts in that reversal I'm looking for early next week. And let's see what happens from that standpoint. I think that's a pretty good way to look at the ensuing scenario. And the dollar is fighting, right? The dollar came all the way up into the 20-period moving average today, and we remain above the 95.68 critical level. So let's see what happens in the dollar. There's nothing to do. We're in the middle of a range. All of a sudden, there's a new range created. You know, there's two ranges here. There's three ranges. There's as many ranges as you want it to be. A low and a high, and here's the middle of a range, okay? Or we can do it like this and say, my most recent range is a low and the high from here, and here's today's high, and here's where we finished, so we're in the middle of that range. So there's nothing to do. We just have to wait for this to tell us what the next story is. In my book, you got to close above 96.705 on a daily closing basis. Basically, you got to close above the 200-period moving average right here in order for the dollar to get into the most bullish position. Until and unless that happens, nothing doing. Other than that, I think that's everything that I intended to discuss tonight. I'm wishing everybody a fabulous weekend, and let's go see what happens into Monday and Tuesday of next week and see if all these forecasts and analysis turn out to be at least half correct. And with that, I'm David Frost, My Strategic Forecast. Thanks for tuning in for another episode of Common Sense Market Analysis.